Bringing out Harris Oakmark, U.S. Investment Officer Bill Nygren. And Bill, welcome to the show. First, I want to just find out from you, why has this happened? Why has growth dominated value for almost a couple of decades?
Well, thanks for having me, Charles. I think there's several reasons for it. One is the starting point. If you look back 10 to 15 years ago, the spread between the companies that were growing faster and those that were growing slower was quite narrow. At Harris Oakmark, we were writing about how buying above average growth at average prices was also value investing. And then the second thing that we've seen that has been quite unusual is the reacceleration of growth of these companies as they've gained exceptional size. Typically, as companies get bigger, you expect them to kind of regress to the mean, and just the opposite happened. As the Mag 7 stocks got even larger and larger, their growth rates accelerated. And I think that's why we've gotten to these historically large spreads between high growth companies and moderate growth companies.
What about the role of passive investing? You know, it feels like the fix is in. Like every week, people put money in these in their accounts, the retirement accounts. Those retirement accounts buy the biggest names. The biggest names get bigger, and it's a virtuous cycle.
Well, if you think about the S&P 500, passive is buying everything, and active, if you put all the active managers together, their portfolio looks the same as the passive portfolio. Right. So I don't really buy into that idea that passive is driving a wedge between high growth and moderate growth businesses. In
your third quarter letter, it's titled Rethinking the S&P 500, Why Value Stocks Deserve a Closer Look. You have 5 reasons for that. And we kind of touched on already the S&P 500 having become highly concentrated. And then, of course, the 1,000 value index offers broader diversification. I feel like that's going to be a theme going into 26 in general, right? People are looking to go beyond just a handful of names.
Well, I think, we've had a whole generation that's grown up thinking that the safest way to invest their money is just to go into an S&P 500 index fund. You've even had some people who thought that that meant their assets were spread broadly across 500 names. What you have today is, in the past decade, the S&P has really become a highly concentrated technology mega cap growth fund. And I think people need to revisit the idea that the S&P 500 is in any way tethered to them meeting their long-term financial goals. What we find interesting is if you look at the Russell 1000 value today, it looks a lot like the S&P looked a decade ago. It's widely diversified across industries, across different businesses. It's got a better growth profile than it's ever had because these mega cap growth companies in the S&P 500 are pushing out traditional businesses that are above average growers into the Russell value. So the Russell value is this nicely diversified, better growth than it's ever been index. And I think it better ties to people's long-term financial goals. And at a minimum, someone whose portfolio is S&P 500 centric can probably look at reducing both the risk in their portfolio and also potentially increasing the return by adding more value names, whether that's the Russell value or a fund like Harris Oakmark. It's an unusual time right now that adding that to a portfolio of indexed funds is actually a risk reducer.
Bill, we don't have time to go through all of the names that some of the names that you're focused on right now. The commonality is certainly these 4 P ratios are single digits, in some cases low double digits. But I also see names that are like Fiserv, right? High flying stock has gotten hit pretty good, and so it feels like there's some quasi bottom fishing. A lot of these names like Merck, I know, pay a pretty good dividend, or some of these other names. And they're all kind of household names, right? I mean, so investors should not be intimidated by these. In fact, maybe you can sleep better at night with these names.
Well, and I think one of the reasons you should sleep better at night with these names is with such low PE ratios, their free cash flow yields are high. And most of the companies that we own today are giving a lot of that capital back to shareholders. to the owners of the company. And whether that's through dividends or repurchase or both, getting that capital back is a big risk reducer compared to these companies that don't give anything back to the shareholders, and your entire bet is based on what the company is going to be worth a decade from now.
Great stuff, Bill. It's a pleasure to have you on the show. Thank you very much for sharing your wisdom and your experience.
Thank you.